Here today with famed value investor Jeremy Grantham, founder of Boston fund manager GMO. Jeremy, let's get straight to it. Is the US market in a bubble or is it different this time?
That it really is a rat-think question, you have to agree. It doesn't have the characteristics of a bubble. I think a simple way of defining a bubble is that it has to have nearly perfect fundamentals which have to be irrationally extrapolated with considerable euphoria around. You remember the style from 2000 or Japan in '89, or the US housing market, house prices will never decline, or 1929 in the old days was a classic. We have almost none of that euphoria. We also have very imperfect fundamentals. The productivity rate is fairly dismal and has been all this cycle. The GDP growth rate has consequently been very anemic and has been all this cycle. It's hard to know what fundamentals would be considered brilliant. It's hard to see how they're being extrapolated indefinitely, and it's very hard to see what constitutes a material amount of euphoria. It's only the other day people were lining up to commit 10, 20, 30-year money for guaranteed no real return. Yeah. This is not a real description of mad desire to invest in the stock market.
Okay, so the bellboys and the lifts aren't giving you tips, and that's a good
They're
sign
definitely
that it's
not.
not wildly exciting. But at the same time, you're not that keen on US equities. I mean, why not be a big buyer of US equities if people are really, you know, not excited about them?
Well, getting back to your nasty question about this time is different, value managers always like to say it's never different, but I think it's fair to say this time is decently different. To give the two simple, most important examples, the profit margins of US companies have been 30% higher since '97 than they were in the prior 70 years. 30% higher is not a small number. It gives you a lot more cash flow. And they haven't been spending it on growth. They've been a little lower on capex, and consequently they have a lot more left over than they used to have, and that makes for a very different game. The other thing that's different is the price. The price reflects this enormous increase in cash flow and has gone up by 75%. So the PEs on a 10-year Shiller basis are fully 70–75% higher than they were for really the previous 100 years. So two incredibly important things have clearly been different.
Does that mean you're ready to buy the dip? I mean, we just had a dip, some disappointment around Trump, a bit of a dip.
A bit of a dip.
Not drastic by
no,
normal standards.
In the good old days, that was a good day's work.
Well,
I mean,
indeed, yeah.
1.5 or 2%, I mean, nothing really. We might nibble some stocks, I should think we would, if the market went down 15–20%.
15 or 20%?
Yeah, I mean,
okay.
That's just an ordinary day at the office, 15 to 20% over 6 or 9 months. It doesn't change the outcomes for pensioners or anything, and shouldn't be taken that seriously. But it's good to have some cash up your sleeve if it happens.